see canned tuna, corned beef, and milk, you'd probably think of your usual routine. Putting them in your grocery list, grabbing them from the store, and placing them on your own shelf. Just your everyday household staples. Today, we present a company that has taken these household staples and turned them into anchors of sustainable growth. We present Century Pacific Food Incorporated, the largest canned food manufacturer in the Philippines. We, Athena Investment Research, issue a buy rating on CNPF with a price target of 90.50 pesos, presenting a 30% upside. We are a buy on CNPF because of 1, its market leadership in the resilient Philippine canned food space. 2, its brand building ability that drives new levers of growth. And 3, its strong position to deliver resilient, long-run earnings growth. At current levels, CNPF is trading at 14 times PE. Valuations we believe are attractive for its growth prospects. Now, off the top of your head, you may recognize CNPF for Century Tuna and Argentina corned beef. However, CNPF today is a diversified manufacturer of branded and OEM products, with branded accounting for 74% of revenues. Its entire product portfolio revolves around food and non-alcoholic beverages, a resilient expenditure category that accounts for more than 40% of domestic consumption, making CNPF a strong play on the robust Philippine consumer theme.
Starting with our first point, CNPF is the market leader in the resilient Philippine canned food space. CNPF is the consistent market leader in the domestic canned food industry, holding market shares of 54% in canned fish and 37% in canned meat. The company is the price leader, with competitors typically following suit when raising prices. What makes CNPF stand out are first, its strong brand equity, and second, its superior sales channel coverage. On brand, CNPF's products hold top-of-mind awareness among consumers, accounting for 7 out of 10 canned goods sold in retail outlets. On sales channel coverage, CNPF's SKUs are available in 904,000 outlets, covering 78% of domestic points of sale, higher than peer food manufacturers. Now, it's worth noting that yearly per capita canned food consumption in the Philippines stands at $10, already above the ASEAN average. But with flat refrigerator penetration, demand for canned goods is expected to stay stable, with forecasted growth even above that of ASEAN peers. Industry growth is further supported by increasing urbanization and growing retail sales. As market leader, we expect CNPF to be best positioned to capture the resilient demand and drive a healthy 8% CAGR for its canned food segments.
Moving on to our second point, CNPF's brand building ability drives new levers of growth beyond its stronghold in canned food. CNPF's branded products balance localized marketing and innovating in line with consumer trends such as convenience and health. Its products are positioned across the wide socioeconomic spectrum, allowing the company to benefit from broad-based consumer spending. CNPF's brand building ability can especially be seen in dairy, currently the company's fastest growing segment. In particular, we highlight CNPF's gains in the powdered milk category, where market share leapt from 2% to 20% in less than 4 years. Now, growth is expected to remain strong in the domestic dairy category, as yearly per capita consumption stands at $8, below the ASEAN average. We expect CNPF to capitalize on these strong growth prospects, driving a CAGR of 20% for its dairy segment. In the long run, we expect CNPF to diversify into other fast-growing segments in the domestic food and beverage space. Just recently, CNPF ventured into branded coconut cream, presenting upside risk for diversifying into the segment. Bringing it all together, we expect steady contributions from canned food, strong growth in dairy, and stable OEM volumes, driving a revenue CAGR of 11%.
This leads us to our last point. CNPF's focus on diversified staples and operational leverage positions it for resilient earnings growth. We expect margin expansion to underpin a robust EPS CAGR of 14%. Margin expansion is mainly driven by 1, higher share of branded sales, and 2, key operational synergies. First, we expect branded revenues which have higher gross margins of 24% versus OEM to account for 76% of revenues by 2023, leading to a higher overall GPM. Second, because of its strategic diversification within and across business lines, CNPF stands to benefit from key operational synergies. CNPF enjoys vertical synergies from sourcing production upstream for its OEM and horizontal synergies from shared storage and distribution for its branded segments. This is best seen in CNPF's 11% cash OPEX to sales ratio, lower than that of peers. Now, what does this mean for you as an investor? CNPF's focus on diversified staples, coupled with its ability to grow branded sales and extract operational synergies, positions it for resilient, long-run earnings growth. We also point out CNPF's balance sheet is supportive of additional capacity or M&A, reflecting its ability to generate superior shareholder value.
On to our valuations, we believe a sum of the parts valuation is the best valuation method for CNPF. We valued CNPF's branded segments via DCF at a WACC of 10% and a terminal growth rate of 3%. Our WACC uses a risk-free rate of 5%, while our terminal growth rate is based on long-run inflation in the Philippines and industry growth in mature markets. Our implied PE for CNPF's branded segments is 21 times, in line with the average PE of regional branded food manufacturers. Meanwhile, we valued CNPF's OEM segments via relative valuation due to their cyclical nature, using the normalized PEs of peers. Notably, 90% of our estimated enterprise value is attributable to CNPF's branded segments. Over to relative valuation, at just 14 times PE, CNPF is currently trading below its historical average PE of 19 times. Current levels are also at a discount to domestic and regional comparables. We believe current valuations are highly attractive given CNPF's superior earnings growth and ROE versus peers. Now, CNPF has been compared to tuna manufacturer Thai Union, with CNPF actually trading close to Thai Union's historical average PE. But we think CNPF's higher share of branded revenues merits a higher multiple. All in all, at 14 times PE, investors are paying an attractive price tag for CNPF's resilient earnings growth and high ROE.
Given our positive view for the stock, we acknowledge inherent business risks that may affect CNPF, with focus on the following. First, CNPF is exposed to fluctuating prices for its key commodities, given that 88% of the company's cost of sales comes from raw materials. However, CNPF can mitigate this with pass-through pricing and strategic inventory hedging when prices are low. In addition, its diversified revenue streams allow the company to limit single commodity price risk and reduce margin volatility. Our sensitivity analysis further shows that all commodity prices would have to increase by 9% before our recommendation becomes a sell. Second, CNPF is exposed to forex risk given that it imports 42% of its raw materials. However, this is offset by CNPF's export-focused OEM segments, which provide dollar-denominated revenues to bring down the company's net exposure to just 7%. To double-check, our calculations show that an additional 5% depreciation of the peso only brings down our fair value by 4%. Lastly, CNPF's expansion plans raise the possibility of execution risk. However, CNPF's growth strategies are backed by its track record of disciplined expansion and active SKU management. Should revenue growth slow down by 5% across all segments, our price target will still be 18.19 pesos, 21% upside, and still a buy recommendation. CNPF's risk mitigation efforts and growth strategies are backed by experienced management who are committed to driving sustainable growth while adhering to best ESG practices.
To recap, we are a buy on CNPF because 1. It is the market leader in Philippine canned food. 2. It has the brand building ability to drive new levers of growth. And 3. It has the capability to deliver resilient, long-run earnings growth. So, with a price target of 19.50 pesos, presenting a 30% upside, we reiterate our buy recommendation for CNPF, a catch for the long haul. Thank you, and we are now ready for your questions.
And can you talk about the pricing flexibility of CNPF?
CNPF is exposed to fluctuating prices for its key commodities. So our sensitivity analysis shows that all commodity prices would have to increase by 9% over the entire forecast period from 2020 to 2030 before our recommendation becomes a sell.
I mean, how flexible or what kind of pricing power does CNPF have?
So CNPF is actually the price leader in its various segments compared to its second and third largest competitors. So if we look at the prices of its canned corned beef, if we look at the price of its tuna, and if we also look at the price of its branded milk, CNPF is among the cheaper options, which is how it is actually in the powdered milk segment. This was how they were able to grab a lot of market share by being priced cheaper than the competitors. And because they are the price leader in the various segments, they are able to control the prices of the industry as a whole. So when they move their prices, competitors follow suit afterwards.
You briefly touched on ESG. Could you talk more about it and how does that factor into your target price?
CNPF follows best ESG practices. For the governance side, CNPF maintains its related party transactions at arm's length, so it ensures that no special incentives are given to any related parties. For the social aspect, CNPF has social action activities in place to help people find jobs, and they also provide feeding programs for those who are in need. As for their environmental policies, CNPF actually upholds 12 out of the 17 United Nations Sustainable Development Goals. Aside from this, their products are certified both internationally and locally for being organic and sustainably sourced.
Just a follow-up, how does that factor into your target price?
So we believe that the corporate governance policies of CNPF really back their strong brand building ability, especially in the dairy segment. So we observe a CAGR of 20% for the dairy segment, and this is what really drives our growth in the coming years for our forecast period.
Since so much bulk of the value of the company is concentrated on the branded side of the business, just wondering how sensitive would, let's say, the earnings of CNPF and the valuation would be in a situation where the input cost increases for a prolonged period of time. Like what would the company's strategy be with under such circumstance?
So here you can see our price sensitivity for CNPF with an EPS growth re-rating of 13% instead of our forecasted 14%. The price target would go down to 18.71 pesos. Still a buy recommendation and still 20% upside. So we can observe that the EPS CAGR would have to go down to 10% before our recommendation becomes a whole.
What's its price growth assumption?
Our price growth assumptions for the branded segment specifically is 3%, in line with the food and beverage inflation of the Philippines. If we decrease the price growth assumption by 1%, the price target goes down to 18.71 pesos and so on. So the price growth would have to be negative for us to have a hold recommendation for CNPF.
What about on the cost side? The input cost?
For the input cost side, as what was mentioned earlier, CNPF imports 42% of its raw materials. And so we see that an additional 9% increase in the prices of all commodities would lead to our recommendation becoming a sell. But if you look at the short-term commodity price risks, meaning the prices spike in the short term, so in 1 month, we see our target price fluctuating to the 22 peso levels and still hold a buy recommendation.
Just to add, for the sensitivity of CNPF to its input cost, we also calculated a correlation between the different commodities to show that historically, these commodities do not move in the same direction. So for example, the skipjack tuna prices and the skim milk prices actually move in a negative direction. So with that, we don't see all commodity prices moving in the same direction, affecting the margins of CNPF.
Okay, did you look at the 9M results? What's the earnings growth?
For the earnings growth of CNPF in the 9M, it's actually around 75% of our forecasted revenue for 2019.
Earnings growth year on year, sorry. That's only 10%, parang maikli. Pero my question is, why is your full year 2019 17.4% growth? So laki nun ah. Oh, anyway,
For
yeah.
For the 2019, it is really because for our revenue assumptions for the milk, we
We're only talking about fourth quarter. Because at 9M, your year-on-year growth is only 10%. Your full year growth is 17.4%. So your fourth quarter should have grown astronomically, di ba? I'm just... Anyway, so okay lang. Kasi if I look at your report, pagka ganun, kasi syempre kung bike side ako, I look at the quarterly results, then I see this full year, medyo iba yata yun. Anyway.
Just to clarify the question, is it because our revenue growth is too much compared to...
I really don't know. But actually, in fourth quarter, I cannot understand why it's really that high because, again, I will bring the topic on the ASF. Beef prices shoot up in fourth quarter. Actually, it started in July. Okay? So, I don't see gross profit margin would be really that maintained even for next year.
For the gross profit margin, we used a normalized margins given that commodity prices are really difficult to...
Based on historical, right?
Yes, based on historical 2016
Yes,
to 2018.
but the reality is not historical. That's what I'm trying to point at. Touch base tayo. ASF nga eh. Oh, okay, we're talking about pork, but the imported beef prices went up because of the demand for pork. Bumaba. So, alternative is beef. Then, raw material ang beef sa Argentina, right? And that's the driver, one of the drivers of gross profit margin.
Sir, sorry, just to clarify, we ensure you that we did take into consideration the 9-month disclosures of the company when we came up with our revenue growth assumptions. But our forecast for the end of the year, we also made sure to sense check it and make sure that it's in line with the consensus revenue growth forecast. And regarding the gross margins, sir, we made sure that we used the normalized margins from the previous year, sir. So despite having different fluctuations in volatility in commodity price inputs, we still use the normalized margins.
And to add, we also did a sensitivity analysis for our all the commodity prices, and even with even if we expect a +2 standard deviation for all commodity prices, our target price still results to a buy recommendation, as you can see here, where we have 13% upside. So
Actually, what I'm waiting for is that your tuna prices are going down sharply. That's the answer I'm looking for. Anyway, yun lang, masyado mataas yung 17.4. It's not realistic because the 9M is only 10%.
much, Team Athena. So we're now down to our last team. Are you ready? Yeah, so the last team is called Blue Chip 5. So the team is composed of Edmar Bandoja, Faye Elahon Bingkang, Gian Keziah Lynn Garcia, Carenza Marie Gonzalez, and Shania Shashane Mayo. Ladies and gentlemen, a round of applause please to Team Blue Chip 5.